Hello, everyone, and welcome to the Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us here in the chat. We're really excited to have you guys with us today. You've got, just as usual, this is wonderful timing for these sessions, being that we had the day. So we're really glad to have you guys with us tonight. Jeff's got a lot of great information to share. If this is your first time on with us, you'll notice that your microphones are muted. That's so we can all hear Jeff and I talk. But don't worry, there is a Q&A box. Put your questions there, and we'll get to those throughout the evening and also at the end before we sign off. If you have any questions about your own account with Altos Trading, trade alerts, access to Trade Trainer Zillion, email support@altostrading.com, and we'll get to those sometime tomorrow. But before I bring on Jeff, let me read the disclaimer. Altos Trading LLC and Trade Trainer Zillion software is intended to be used as information services for subscribers, and it includes opinion as to buying, selling, and holding various stocks and other securities. However, the publishers of Altos Trading, Trade Trainer/Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of any particular circumstance of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the Trade Trainer/Zillion software or any other persons who buy, sell securities should do so with caution and consult with a broker or investment advisor before doing so. And before I forget to say, if you do have to hop off today, you get disconnected, anything like that, don't worry. This is recorded and will be available in the members area later tonight and also on YouTube. So if you're on YouTube, be sure to like and subscribe so you can get more of our videos as they come out. With that being said, let me bring on Jeff. Jeff, you there?
I am here.
All right.
Hello, everybody. Welcome. Crazy day in the markets.
Yeah.
Yikes.
I know, right?
Yeah. So going to be the topic of our conversation tonight. We're going to cover the, broader markets, the major indices, review what we kind of follow up on what we reviewed last week with volatility expansion, which worked out very nicely as we talked about last Tuesday. And then we'll transition into how to handle these types of market sell-offs and crashes. So I wouldn't really classify this as a market crash, but similar concept in terms of the psychology behind it and how markets tend to react after these types of events. We'll talk a little bit about the catalyst and what to expect in the coming days and weeks, and then open it up to ticker roundtable. And by the way, we're having technical difficulties with my camera, so spared you guys from looking at my ugly mug today.
Well, I figured, Jeff, you would probably didn't want everybody to see your Hooters.
Yeah, well, yeah, that too. So, yeah. But good to see you guys all here, and once again, welcome. Got a lot to cover today. Again, markets have been volatile. We had a bit of I'm going to point it out as well, but a bit of a warning of a potential sell-off today. So what caused that? Sorry about that. Was of course this CPI for August. So consumer price index, that report came in with a month-over-month increase in inflation. I think it was like 0.1%, and core inflation rose like a little over 0.5%. So year over year, inflation is at 8.3%. So it's relatively, small increase, month over month. But then that, of course, causes fear of further, aggressive Fed action, and ultimately is what resulted in the market selling off today. Do I think this was an overreaction? Absolutely, big overreaction. I think it was, as far as the magnitude of the sell-off and the percentage decline in the major indices, way too extreme. But this can, again, create opportunities for us. So that's what we're going to take a look at. So we'll start out by taking a look at the levels. Well, we're going to watch for this week. And we're going to throw in trend lines here too. Normally we just look at horizontal support and resistance, but Trend lines are also an important component of support and resistance analysis. So we'll start out by drawing one because so far this has been going back to the June lows, which were the lows on the year, a significant support trend line. So if we look at the market reaction at this trend line level, we see buying behavior coming off of this trend line. And so today, the sell-off was into that trend line, which closely coincides with a horizontal support level, which we didn't quite come down to this 3,900 century mark. But today I've been reading a lot of technical analysis from fund managers and institutional participants in the market that monitor these levels, and there's a lot of talk around the 3,900 level on the S&P. So that's one that we'll want to watch really closely, particularly tomorrow if the sell-off continues, because if we break and close below 3,900, that's going to be a very bearish indicator of short to medium term market direction. So we could see an acceleration of the sell-off if we break below 3,900 and close below that level. But the good news is we've hit this trend line support. I think there was an overreaction today to the CPI, August CPI report. So we may see markets recover a bit from the current close from today, tomorrow and so. Now, so in terms of these types of market sell-offs, we always want to look at what was the catalyst and what is its potential for causing long-term directional movement in the market, and how was that catalyst there in the past, or is it something that's brand new? In this case, it's not really brand new. It's a new, the latest CPI report, but it's related to a catalyst, inflation that's been present for quite some time. So the reason that we look at all those factors is if there's an overreaction or a major sell-off based on a one-time report, often it tends to stop there, or at least short term. So if we see more selling tomorrow or Thursday or Friday, that emotional reaction that occurred because of because this is basically a fear-based sell-off. People are afraid that the Fed is going to continue to be aggressive longer than they expected. So the Fed isn't going to pivot to more of a dovish stance as soon as the markets would have liked them to. That's the expectation, but we don't actually know that. It's just speculation, but it's probably likely. But it's not like inflation, skyrocketed from July. It's just it didn't stabilize and go back down. So so for all those reasons, it's a fear-based sell-off. It's not necessarily rational. I mean, let's see here. I think trying to see if I can find that number. I was looking at how much the NASDAQ wiped out today. Let's see here. So the 6 largest US tech companies in the NASDAQ lost more than 500 billion in value just today from this sell-off. So that's extreme, and it's really irrational. So those are the fundamental catalysts, and then looking at the technicals, these are the trend line level and then the horizontal level we're going to want to watch for support. So if we see a break in a close below 3,900 on the S&P, that is going to be not good. But I'm going to show you some reasons why I think that's not as likely as we look at the VIX and the VVIX, which is the volatility index that measures the volatility of the VIX. So let's keep an eye on these. And then also, we were starting to see some volatility contraction, but if we look at our volatility bands, the one bearish aspect here as it relates to volatility is we have our 2 standard deviation bands both pointing down. So that also can preclude or be an indicator of continued selling in the market. So we'll just want to kind of keep an eye on those. What we want to see is we want to see our 2 standard deviation lower volatility band start to point back up as price comes into some of these support levels. So that's what we'll keep an eye on there for the S&P. If we do break 3,900, again, I think there's going to be a much greater likelihood of retesting June and July lows. It probably is not going to occur this week, but we'd be looking, our next major level of support we'd be looking at is 3,800 on the S&P, and then 3,750, and then 3,650. Okay, so those are probably maybe levels that we'll end up talking about next week if we don't find support at the trend at the trend line and the 3,900 horizontal support. But also, what I wanted to point out is last week we talked about the volatility expansion, right? So we had diverging volatility bands with price trailing the lower band, and we talked about the markets finding support within this 3,850 to 3,900 support zone, right? And looking for a reversal back up. And so we predicted that the markets would rebound back up into this 40-50 level, which they did. So we called that very nicely last Tuesday on our session. And that's what we call our slingshot setup. So when that occurs, where you want to start being cautious, whether it's holding off from entering a long position or protecting any open long positions in a portfolio, is when price comes back up to the mean. So that happened right yesterday. Often we see, particularly when we're in a downward sloping mean, we see sell off from there. So that was one thing to be cautious of yesterday. That we were trading at the mean after this volatility contraction that followed the volatility expansion that we talked about last Tuesday. And then we're going to look at the VIX, and I'll show you what happened yesterday as it relates to the VIX and the S&P and other major indices that also gave us some, caution going into, the open today. So we'll get over to the VIX here shortly, but let's take a look at the NASDAQ at the Qs. And of course, tech got hit particularly hard today. The Qs closed down almost 5.5%, which is brutal. And same thing. So we had our volatility expansion that we talked about last week. And we found support around the level that we had mapped out last week, and then rebounded up where we predicted the Qs to go back to right around 308, which they exceeded a little bit, but then hit the mean. So again, when we get these volatility contractions following a sell-off, which is a volatility expansion to the downside into a downward sloping mean, always be cautious there. And as we look at support on the NASDAQ 100 ETF, the QQQ, we've encountered that right around 292 today. So you can see that was the right around the rebound point from last week. And then we've also got a trend line to look at here, but in this case, it's a bit different than on the S&P. So this trend line from the June lows on the NASDAQ was broken in this volatility expansion. You can see we actually came back up and retested it. So if you look at this trend line, it perfectly coincides with the middle Bollinger Band, the mean on yesterday's high. And so we found a lot of resistance there. And it just took this, 0.1% month over month increase in CPI to panic the marketplace and have this major sell-off today. So we're now really below a trend line support on the NASDAQ, but we've got some horizontal support to take into consideration. Also kind of right around 287 is one to watch. So if we break 292 tomorrow, you can see that we've had past support and resistance around this 287 level. So we'll keep an eye on that for tomorrow. And if the sell-off continues, I didn't really point this out on the S&P, but look for, if we continue to rotate lower, look for support at the lower volatility band as well. And I particularly look for that to coincide with, and see right now that lower volatility band actually is quite close to this horizontal support level. So, look for the confluence between these horizontal levels and standard deviation bands, because they can provide a good clue of where a market might turn around in the event of a continuation of the sell-off. So let's take a look at the VIX, because something interesting happened here, and this is a good lesson for the future as well, if you miss this. But something interesting happened here. So yesterday we had a big move up in the markets, right? Typically, because the CBOE volatility index, or the VIX, is inversely correlated with the S&P 500. Generally, when we see the S&P move up, we see the VIX go down. But where you want to be cautious is, and this will, and likely this happened partly because the anticipation of the release of the CPI report today. But nevertheless, whatever the outcome of that is, it still often leads to a market sell-off. And what that is when you see the VIX go up when the S&P 500 goes up, because generally, they're inversely correlated. As markets rise, volatility falls. But yesterday, the VIX actually went up significantly. So it went up almost 4.75% on the day yesterday, while the major indices also went up. So when you see that happen, always be careful. Whether it's just staying out of the market and waiting for things to settle, or hedging open positions, or if you're experienced with this type of market behavior, it can certainly be used for speculation of a market sell-off. But this was a warning here yesterday. We see almost a 5% spike in the VIX and volatility in a rising market. So that can often tell us that there's more risk in the market and a higher potential for a sell-off. So when we see that in combination with the major indices, the S&P, the NASDAQ hitting resistance levels, in the case of those, the middle Bollinger Band, as well as horizontal resistance, that's something to be cautious about. So that was a bit of a clue yesterday, but nevertheless, very, very surprising, the magnitude of the reaction today. I think it was overdone, which often sell-offs are, right? They're over exaggerated. So when we get an extreme, emotional reaction to a catalyst like a CPI or a non-farm payroll or something, they tend to be relatively short-lived. Now, this could obviously extend for some time as we wait for the Fed meeting and whether they're going to be more aggressive with raising rates and things. So it may have more of a ripple effect, but we don't expect this type of extreme bearishness to persist for very long after something like that occurs. So what we want to look for on the VIX, and the good news is this resistance level that we keep spiking into right around 28 to 29. As there's a downturn in the market, when we find support in the S&P and the NASDAQ, and the VIX is finding resistance, that could also, give us a little bit of, peace of mind that there's a potential for this major sell-off from today to reverse back. And maybe it just kind of it wiped out like a week's worth of gains in the market. But maybe that was it. Maybe that's, what it needed to correct based on, the fear that people have about inflation. So the good news is we're at an inflection point. So we have some information here that we can use to help us navigate the markets through the rest of this week and beyond. So this 28 to 29 zone on the VIX is going to help us do that in combination with the support levels on the S&P and the NASDAQ. So what we're going to want to watch for tomorrow and through the rest of the week is this resistance zone from 28 to 29 on the VIX going to hold, and will we see volatility subside from this level? And then at the same time, will the S&P and NASDAQ find support at those levels that we just mapped and start to move up? If it does, then I would say today's reaction was probably it for now. If it doesn't, if we see the VIX move up through this resistance zone, and like I said, if we see the S&P close below 3,900, then that's going to tell us that the markets are very likely going to continue to move lower. So we're at those inflection points right now. So we need to watch. So if we break through this 28 to 29 resistance zone on the VIX, and we start spiking up into 3,700, then we're going to see a pretty significant rotation lower, continuation of today's sell-off, and potentially even a retest of lows from June and July. So that's going to be the information we're using to determine what how the dust settles from today's market reaction to August CPI. And then also, let's look at the Vivix. So we had also had clues from the Vivix. So the Vivix again is the CBOE VIX Volatility Index. So it's kind of a funny thing, in terms of what it tells. It's basically measuring the volatility of the VIX. But it's a great tool because it kind of behaves like the VIX, right? So it has very strong support and resistance. So we can also use the Vivix to help us determine if the markets are vulnerable to sell-offs. And they're generally vulnerable to a sell-off at a major support level. So if you look at the Vivix, let's see, what is this? Right around 8350 to 84. we see this major support level where previously when the VVIX comes down into this level, the VIX will spike. Sure enough, and this actually, I always kind of, the way I look at the VVIX and use it to teach our members is that it actually gives us a little bit of advance warning relative to the VIX itself. So the VIX can often give us advance warning of turning points in the market like it did yesterday. And the VVIX can actually give us warnings before the VIX. So see how on Friday of last week, the VVIX came down into this support level, right? And then we start to see it move up yesterday. So this was, in addition to what the VIX was telling us, can also be used as an indicator of turning points in the market. So similar to the VIX itself, we're at major resistance on the VVIX. So that's actually a good thing because it can help us navigate what will happen if this resistance level holds or if it breaks to the upside. So if we see the VVIX break up through this resistance level, I'm curious actually to see this high from August 22nd was 95.97, and today was 95.66, so very close. So if we can see it break through this 95.97, we'll just call it 96, and we see the VIX break through that 28 to 29 resistance zone, and then we see the S&P close below 3,900, then that's going to be a very bearish case scenario. If we see this, as you see, this is really in a range. So if we see this range hold and the VVIX come back down, so this might give us an indicator actually tomorrow. So watch the VVIX very closely tomorrow. If we see the VVIX come down off of this, even if the VIX itself doesn't significantly rotate off that 80 or 28 to 29 resistance zone, this could be an advanced indicator of a rotation back higher in the markets. So the VVIX can give us really good information in advance of even the VIX itself and the broader indices. So watch the VVIX very closely tomorrow, and particularly this 96 resistance level, because if we see the VVIX come down again off of that level, trade back lower, that's going to be bullish. If we see it break through, that's going to be bearish. All right, so let's pause right there and see if there are any questions, Richard, that came through.
Mike's wondering if the VVIX has options on it. I don't think it does, but
no, it does not. It does not have options on it. So it's purely use it as a tool to. It's basically a forecasting tool, and again, using it with the analysis that we run on the indices and the VIX itself, with support and resistance, particularly, and you can also use the volatility bands, the Bollinger Bands on the VIX as well too.
Let's see. Chris is requesting if we can put the VVIX and Zillion. So we'll add that to the list.
Yeah, well, good, yeah, and that's why I'm looking at it in TOS, because we don't have that ticker loaded in Zillion. But yes, we will send that request over to the tech team and see if they can add that in.
Let's see. Kate says this seems to be a lot of technical damage right in front of next week's Federal Reserve anticipated rate increase. Soldiers get 1 foot in your foxholes.
Yeah, but just be careful. I mean, again, the market sentiment tends to outrun and overrun actual action by the Fed. So a lot of this is really expectation. Once people are kind of accept the fact that we're going to continue to have a hawkish Fed, then you know, a lot of times that fear subsides and things go up. That's why, you know, I'm not going to be shorting the market right now. You know, I don't want to short the market. Likely the sell-off already, you know, most of that sell-off has already taken place. You know, unless we break some of these support levels and we see the VIX continue to spike.
Let's see. David's asking if high volatility expected for quadruple expiration week.
Yeah, I mean, it can. When we get, that's what they call like triple witching, or when you get a confluence of expirations across you know, different asset classes, you can see more volatility. So yeah, this is the monthly expiration week of September, and probably more so than volatility, we may see like some of these levels. Yeah, we may see the market react around some of these levels a little bit stronger, but it doesn't necessarily have to be an increase in volatility. We just may see some of these levels hold more strongly. So it could go the other way too. Like if 3,900 holds on the S&P and we rotate higher, we're likely going to see a drop in volatility even around expiration. So it can be, I think at this point, you know, inflation and the Fed are really, you know, basically, you know, crowding out all these other kind of things that normally occur during, you know, quadruple witching and things like that. So I'm not putting a whole lot of weight in that aspect of things this week, but possibly.
All right. Let's see. Someone's asking if we can review the monthly charts.
Yep. Yeah, I was going to get to that as well.
That's all really in particular what we talked about so far.
Okay. Yeah, and so this is actually interesting. Of course, you know, we're analyzing this based on a close on the month. So we still have, you know, we're about halfway through the month. So we still have the second half of September. But yeah, it was looking like up until today, you know, that things were looking good. And we were trading back above 4,000 on the S&P. But we're still above the 36-month moving average, which again resides right around 3,800. So remember, we map that horizontal level on the daily chart, right? 3,800 as support. Well, that coincides with a 36-month moving average. So there's going to be very strong support there if this sell-off continues. But we really want to, you know, have our radar up for a break or a close at the end of September below that. So so that's going to tell us a lot as the end of September rolls around and where the S&P is trading relative to that. But for the shorter term, before, you know, we close out the month, so this week and next week, I'm really emphasizing watch 3,900 very closely. If we break below 3,900, things could get ugly. If we can hold 3,900, then I think we have a chance of also holding the 36-month moving average on the S&P. Now with the NASDAQ, we open below the 36-month moving average at the start of September, and we, although traded above it, have reversed lower. So I think there's a much greater chance we're going to see a monthly close below the 36-month moving average at the end of September, in which case that has quite bearish implications, because we've already you know, closed below it once in June, reversed higher and closed strongly above it, had the reversal last August, but stayed above it. So if we close below, when we get a test of the 36-month moving average and or a close below, as we did in May and June, then a subsequent close above followed by a monthly close back below, that tends to lead to a significant rotation lower in the index. Let me see if I can actually go back here and show you that. So let me zoom in here. So like if we look back in 08, right? So here was our test. And then I think that actually closed just slightly above. But we had 3 months testing the average, and then we did get a rotation higher, just kind of like we have this year, last month particularly, or sorry, July. And then look how we then ended up getting a lower close, and what happened right after that? Big market sell-off. Let's see if I can go back further. Okay, so here's another example. So this was in the dot-com bubble. So 2000, we're in at 2000, right? We're closing below. We had a reversal above, and then a close back below, and a major market sell-off. So that's why we want to really pay attention. And these happen, pretty quickly, usually within a few months. So if we do get a close below on the NASDAQ, and of course, a sell-off on the NASDAQ can bring down the rest of the market too. So we'll be looking at this in combination with the S&P. But if we get a close below the 36-month moving average at the end of September, then all bets are off for a bullish rebound, and we're looking at a potentially a sustained market sell-off back into June lows or beyond. So then we're really going to want to be looking at our support levels, but there's a significant chance of that happening on the NASDAQ. So we really want to watch this closely and keep track of our levels. We have very strong support around 11,000 on the NASDAQ. So right now, it's looking like we could see a retest of that if we get a close below the 36-month moving average at the end of the month. So we want to look at, there's different ways to play these. We, certainly can, play the market to the downside. We can shorten things when it makes sense, but keep in mind, these also create buying opportunities. So when markets sell off, they're eventually going to, attract buyers and find support and turn around. And that's when we tend to see very big run-ups in the market that are sustained and last, like the last one, over a decade. So I realize that this is, creates a lot of panic and fear amongst market participants, but try to, as hard as it can be to do in times like this, be positive and think of the opportunity it can also create for those who are patient and can wait for these levels that tend to attract buyers and really ultimately create big secular bull market opportunities as we've seen in the past. So so those are the majors on the 36-month moving average.
All right.
I'm going to look at our gauges too. So, looking at short, medium, and long-term trends across all the majors, the S&P, the Dow, and the NASDAQ. We're down on all-time horizons. We're seeing risk come up. We're seeing, as far as market sentiment goes, from more of a neutral to slightly bullish sentiment down into bearish sentiment. So, and then looking at sector performance, we really don't have any strongly performing sectors. We have communication and tech and consumer discretionary get hit really hard in this sell-off today. So if you're at all uncertain, or I think it's prudent just to really wait for the dust to settle, wait to see where the market finds support. And I really don't like to chase these types of sell-offs, unless I really see a major level, broken and closed below with conviction, meaning that, it's a wide range day from high to low, and we close near the low of the range, below a major level or a trend line support. And there's not strong support that resides at a lower level or a nearby lower level. So like on the S&P, like if we have another support level, within a century mark range, so like if we break 3,900 and we have strong support at 38.75 or 38.50, then I don't want to short that either. So I want to see at least 100 points between a broken support level and the next one. And that could happen within a day. If we get a sell-off like we did today, we could just blow through that whole support range. But again, that kind of happened today. I don't think it's going to happen like that tomorrow. But our next major support on the S&P is 3,800. So, if we got to close at like 38.75, that might create some opportunity for short opportunities down into the 3,800 level on the S&P, assuming that, we get a VIX close above that 28 to 29 resistance zone. And I see the VVIX break that resistance zone that we looked at as well. So those are kind of all the clues I'm looking at there. So any other questions, Richard? We could do some ticker roundtable. Want to leave a little time for that.
Let's see. Someone can ask, why is the buy-sell ratio over 90%? That's
so that's our signal algorithm, and it's this lags because it is from all the pending buys that came in. Like if we look at that came in from last, so we had like a buy last week. When did that come in? September 7th. Actually, that was a great signal because it's at the support zone on this volatility expansion. So we had a lot of buy signals coming in on this run up in the market. So the thing to take caution with the buy sell ratio is those are include pending signals. So it doesn't necessarily mean a signal triggered, so that there could be all these pending signals that were lingering from this recent market run up that are no longer going to be valid. But it takes a few days for those to flush out because the signals, the pending signals, the diamonds, the pending buys and sells are valid for up to 3 days following the signal, depending on whether the underlying asset hits the suggested entry price. So it can take a little bit of time for those to flush out. So during extreme market conditions where we get a big sell-off like today, this isn't a good gauge to use as far as market sentiment. This is more like longer term. So I'd be looking at, the risk gauge is going to be more reactive to current day's price action as well as trend. So just keep in mind the buy sell ratio is also going to include pending signals. So not really a great short term, like as of that day gauge of what's, where the sentiment is. A good question. Glad that was asked.
All right. Let's see. There's a few people requesting tickers. Keith asked if you ever use $tick on toss to help with your day trading positions before you get into tickers.
Oh, I don't use tick data, but I don't day trade really. So, yeah, no, I don't use tick data, but if you do intraday trade, yeah, I think it's good to use.
Someone says, can you show the components of XLK using Zillion Tree app? So I'm not sure if they just want to look at the chart or they want to see like statistics or what.
Yeah, so I can click on the XLK, which is basically your tech sector. So there's a lot of components. We have 62 symbols loaded into the XLK ETF. So you can see a lot of these came in quite a while ago, these buys. So even on the ETF itself, that buy also came in back on September 7th. Let's go over to the next one. So most of these, came in 4, 5, 6, 7, 8 days ago. So these are going to be your big tech stocks. You got Apple, Adobe, ADP, AMD, Broadcom. Obviously, these all got hammered really hard today.
Yeah.
Is that the only question on that?
Yeah, that was just kind of just a quick question there. Moshi wants to see LABD.
Okay. Oh, we do not have that one loaded in. Over to toss.
Yeah, guys, we add tickers all the time. We have like how many thousand, like 7,000 in there or something.
Yeah, if you guys have any ticker requests, let us know. We can get those added for you. Let's go ahead and throw on trade trend. Take this. Okay, so we're looking at daily chart of LabD, which is the direction shares biotech ETF. So we had very strong support around 1550. As we zoom in, right now it's in a range really, but it's a wide range because this is a leveraged ETF, so see big moves in it. But today it jumped up over 15%. So let's see here. So the high of our range is right around 25. And again, low right around 1550. So right now we're kind of mid-range. So these can be a bit challenging to take signals from, but if we do get a buy signal near the low of the range as we did there, or a sell right near the top, and we have enough room to play within the range, they can work out. But this is a very volatile symbol, so take that into consideration. But also a bit of a challenging type of price action to trade when you're in a sideways range, particularly if you're not right at the top or bottom of the range. So right now we're just kind of mid-range with resistance right near the high from today. So a little above 21. And so there was another sell signal that triggered here and is currently open with a trailing stop just above today's high. So that's actually, on a short position, a good spot to have the trailing stop, because if we break through them, we're likely going to the high, back up to the high of the range. If this resistance level can hold, we could see a continuation of the rotation lowers back to the bottom of the range. So currently, stuck in this sideways channel on Lab B with a current open sell signal.
Alrighty. Let's see. What do we else we got? We got a few more through here. Raji wants to see AMGN.
AMGN.
Mhm.
Great pharmaceutical company, but got killed today.
Yikes.
It's actually looking at levels here. All right, so Amgen sold off into support. I'm finding going back quite a ways. So right there, pretty much at the low today, call it about 225. And so we've got a volatility expansion here on Amgen. So see how we have diverging volatility bands. We have our downward sloping mean, and we have price trailing and in this case really exceeding the 2 standard deviation move to the downside. So while there was a big sell-off today, these typically at some point will result in a reversal back up. And this was a mini one here. So I'm really going to call the new volatility expansion level right about there. So if we get a reversal off support, which we reached today, if that level breaks, be looking kind of right around 220. And then also right around 215. All right, so these are potential reversal points for Amgen. All right, so this would be our profit target level right here. All right, so if this first support holds, we're looking for return back up. This one holds, we're looking for a return back to that level, so on and so forth. So again, these volatility expansions can create great buying opportunities. You see a lot of them here, actually from this current level. Right, there was one right into this support. There was the volatility contraction. There was one. There was the volatility contraction. Both of these exceeded that, which is another way to play these. If you're not experienced with the volatility expansion setups, or you miss one, or you just want to wait and play it in a different way, a way to do that is wait for it to happen, and then if you get a close, or if you start to get the asset trading above this volatility expansion level, so that's where price begins trailing the lower band as the outer bands are diverging. Then if you a way to play that is if you get a close above the mean, the center line, you can take those for bullish plays as well, because they often result in a significant run up. But you just want to be careful when you do that. Look for resistance, because we got one here actually this was our close. So what I do is I place a buy stop above the high of the candle that closes above the center line. So that would have been this particular candle here. That way, in the case of what happened yesterday and today, where there was no follow through, you wouldn't take the trade. But in the case of these, if you place your buy stop above the candle that closes above the center line after a volatility expansion and contraction, those can be create some nice opportunities. So there's, keep an eye out for overhead resistance. And then if there is overhead resistance close by, either, don't take the trade or put your buy stop level above that. And then look for profit taking at any other resistance level or the upper 2 standard deviation volatility band. So those can be, good profit taking levels on these continuations after the slingshot.
Let's see. Bill's asking for AEHR.
You stumped me. I don't know what that one is. We have it in our system though. Yeah, so here's an example of that, what we just talked about. This was kind of a mini volatility expansion, but yeah, I'm not familiar with this name, but just on a technical basis, so that's not the one I want to use. So we had our volatility expansion here. So diverging outer bands, price trailing the lower band, downward sloping trend line. So again, be careful here because often we get reversals or rotations lower after this type of run up from a volatility expansion to the downside. So again, like if I were to take a bullish play on this, I'd want to see price come up above the high of the candle that closed above, as it did today, the center line, right? So and it's right near a round number 17. So whatever the high of today was, 1686. I'd probably use a number a few ticks above 17. For a long entry if I were to play that type of setup on this with profit target, close to 19, but the standard deviation bands are moving, so we want to keep an eye on that if I were to take a long position off of this setup and as that moves. But there's obviously strong horizontal resistance kind of right around 1850 on this one, so got a little bit of room there if that one follows through. And this one came in off of strong support. So see where this volatility expansion, although it didn't extend very, very deep to the downside, began right around 14 as price hit the lower 2 standard deviation band and as they diverged and broke this support level, which later became resistance. But then as price recovered and came back up through at the time, at this point, which was resistance, now is support. So when I play these like types of setups for a long, I'm using at least the support, which in this case is around 14 and also coincides with roughly with the low from today as my stop level. So if we trade back below that, then I was wrong. Or if we don't break the high and we rotate lower, then no trade. I don't get in. So yeah, this is was kind of a serendipitous ticker suggestion after we just talked about this on the last one. So
yeah,
good example.
Let's see. Home Depot, Larry.
Yeah. I should own Home Depot stock because I shop there like every weekend.
No. You always going there for like one thing and you get like 9 things.
Yeah, I never walk out of there with less than like a $300 bill.
Yeah, it's always like, I could use one of those.
Although I didn't want to own it today, obviously.
No.
Another ugly one, but also volatility expansion here, right? So we're getting the divergent bands. So this was one as well. So see as price is hitting the lower band, and we see that the two outer standard deviation bands diverging, and we see price sloping down, right? So what do? We are waiting for price to come into a support zone, which could, have previously served as resistance as well. And then looking for rotation higher, that happened back here, for a return to the volatility expansion level. So this one played out last week. And then, as we always have to be cautious of, as price comes into the mean, after one of these volatility expansion and contractions for another sell-off. So this is often where we find out whether the stock's going to keep going up or it's going to rotate back to the downside, which it did here. So now we've got another volatility expansion. So we're looking for levels of support. We broke one today at 280. Then we're looking at lower levels, so like 275 roughly, 269 roughly, 264. So on this type of volatility expansion, again, I'm looking for outer bands to start coming in and price to rotate off of one of these levels. Once I get that confirmation, if I take a long trade, I'm looking for a return to the volatility expansion level, which in this case was really right around 280. And that would be short term, but longer term, I expect the shares to return back to the first one of these volatility expansions, which would be right around 295, 296. Once we get a rotation off of one of these support levels back to the upside.
All right. Let's see. Linda wants to see mRNA, Moderna.
Yeah, we all know about that one. Yes.
Yeah, Linda. I was going to say Linda's on. She actually hasn't. She didn't know we were doing these things. She's been with us for probably 4 or 5 years.
I know Linda. I know. Familiar with Linda, but
Welcome
glad to have
back.
you on. Yeah, glad to have you on, Linda. Thanks for joining. You can of course go into our YouTube channel and review any of the past weekly sessions on YouTube. Our YouTube channel is just Altos Trading. So we're kind of in no man's land right now with mRNA. We've actually got volatility contraction to see how the bands are converging. We had an expansion here. We do have some support right around 129, 130, but the real strong support is lower around 124 to all the way down into like the 116 level. So these are the support zones. I would be looking for reversals from back up to the upside. And once we get the confirmation of that, I'm looking for shares to return back up to about 150 where the volatility expansion initiated. These are tough ones though. Like when they're in no man's land, what I mean by no man's land is we're really trading kind of midway between the mean and a 2 standard deviation move from the mean. So see how our close is kind of right in the middle there. Those could be kind of tough situations to navigate. So really use your support and resistance levels and wait for confirmation of a rotation higher. But and then also, really look at what happened off these levels in the past. So, back in March, big move up off this 124 level. Same thing within in May, going down to the 116 support. Mid-June, huge run up. Volatile stock, of course, because a lot of the price action around Moderna is, involves COVID vaccines and things. So, not a stock I'm going to buy and hold for the long term, because I think, eventually probably a lot of that vaccine revenue is going to dry up, or at least subside to some degree. So I think, long term, it's a risky one. But obviously there's a lot of volatility in this stock, and but it does have some well-defined ranges in terms of support and resistance, where you tend to see significant moves. So right now we're really moving down into the support areas from previous resistance. So might create some buying opportunities potentially. Just we have to wait and see how price reacts around these support zones. Another good one to look at.
All right.
All right. We'll wrap up with those today. Those were great suggestions. So if there are any other questions that have come through, let us know.
Let's see. So someone would say, kind of based on what's happening in the market, do you think like doing a straddle or strangle or something like that would be good to kind of take a collar or something to kind of?
Yeah. So it's actually, I was considering doing a straddle and strangle class tonight until we got this big sell-off. I wanted to talk a little bit more about how to handle these and analyze them. So perhaps next week we could do a class on straddles and strangles, because they can be great tools in high vol markets, because you can sell a strangle when you get a big volatility expansion, and they can be really nice high probability trades. We can go in a little bit how to manage them and stuff. So yes, let's put that on the agenda for next week. It's a good suggestion. But a bit of an advanced topic, it'll take us some time to go through them and things. So don't want to shortchange you guys and give you a 1-minute version of it. So let's do that. That's a great one for next week.
That's all I got.
All right. Well, thank you guys. Thanks for all the nice comments I see in here. Thanks, Raju. So we'll again, we'll have the video up tomorrow on the YouTube channel for you guys to review. And then also, keep an eye. I would suggest reviewing it, because we went through a lot of levels and stuff, and they're really significant, starting as early as the open tomorrow. So please try to watch those. So remember, 3,900 on the S&P is the main one. I really want to emphasize. Watch that one because it's likely going to, almost certainly will be a factor in tomorrow's trading, since we're just trading right above it. So keep an eye on those. Review the video in our YouTube channel, and we will see all of you next Tuesday.